All right, let's get started. And a lot of people are joining right now. All right, good evening, everybody. My name is Carla Carter. I am the proud owner of the Boston Agency LLC, TBA. Welcome to the 2022 Entrepreneur versus Business Owner Workshop. Got a lot of stuff we're going to be going over tonight, so please take note, all that good stuff. But some housekeeping rules real quick before we get started. First of all, I'm going to keep everybody muted out until at the end or whenever we start taking questions, because there's going to be a lot of information we got to get through. And so that being said, I don't want to interrupt the speakers or anything like that. If you accidentally unmute yourself, could you please mute yourself as fast as possible? I'll try to do the same thing. If you unmute twice during the presentation, then I'll probably end up having to boot you out just to keep down distraction. Hope not. It'll be a soft boot, like not a mean boot, but I'll still boot you out. All right, and then what else was the housekeeping rules? Hold the questions to the end. If I need to repeat myself, because I do talk fast, especially when I'm excited and I'm passionate about what I'm talking about, I do talk fast, and then these headphones sometimes are not as clear. And so just use the raise your hand feature on Zoom if you're new to Zoom. If you click on the more, so 3 dots at the bottom on your computer, and it says reactions, you'll be able to raise your hand, and I'll see that, and I'll pause, and whoever raised their hand, I'll be able to, get whatever it is that you need at the time. Also, another thing too, if you can save your questions to the end as well, because if you send the question in the chat, if we got a lot of people, which I anticipate a lot of people joining us tonight, and there's a lot of comments going through the chat, it may be harder to scroll through. If you want to just write your question down and ask it at the end, that would be super duper awesome. What else was it? I think that was it. All right, that being said, let's go ahead and get started. We got a few chats already. Hi, everybody. Let me see real quick. I'm going to pause a couple of times because I cannot multitask when I'm in this mode, because I have to continue to let people in as we're going. So if I pause, lose my train of thought, y'all bring me back to where I'm supposed to be, okay? All right, that being said, let's get started. So the things we're going to be going over today, these are some of the things that we're going to cover. The difference between an entrepreneur and a business owner. Also, the business entity types like LLC, sole prop, different things like that. We're going to also go over business credit versus personal credit. And we have a guest speaker to help us out with that. I'm excited about that. We're also going to talk about business taxes, because there's a lot of different things that come with business when it comes to taxes. And then W-2 employees versus 1099 contractors. And then the business mindset. And then after that, we'll have a Q&A session or whatever. The Q&A it depends on how long this process goes as far as us getting information out. The Q&A could be 10 minutes or it could be 30 minutes. Just depends on how long this has gone over. But I anticipate it being at least maybe an hour and a half altogether, including the questions and answers. But y'all know how it's going to go. So we'll see how it goes. All right, so let's get started. All right, so the difference between a business owner and an entrepreneur, or entrepreneur versus business owner. So just in simple terms, an entrepreneur is somebody who starts a business based on like an original idea for like a product or service. So just because I started my tax business does not make me an entrepreneur, because there are already tax businesses in my area. Does that make sense? And of course, it's area based. And so like, say for instance, if there's absolutely nowhere in my whole region, city, whatever, that manufactures black toilet paper, I don't know, and I create it, then I'm an entrepreneur. And then the business owner, of course, is someone who owns a business that offers a product or service that benefits its customers. By that definition, an entrepreneur is also a business owner, but a business owner is not necessarily an entrepreneur. So an entrepreneur is like the person who, has the original ideas that they kind of get off the ground. The entrepreneurs also take the biggest risk too, because most of the time they have to use their own capital and have to try to find different capital and things like that to get started with their new venture. And sometimes that's harder to do because, everybody didn't see the vision. If he was alive, he probably can ask Noah about the same thing, because it never rained before back then. Of course, I got to bring that in. But anyway, something like that. So that's by definition, the difference between an entrepreneur and a business owner. But thankfully, we help both. So all this is going to apply to all entrepreneurs and business owners, everything that we're going to discuss. And so the first thing is the business entity type. And so these are the different types of business entities. We have individual, sole proprietor, LLC, which is single member or multi-member, corporation, and then of course C Corp and S Corp. That's the tax status, but it's also associated with business entities, and then also a nonprofit. And so let's break some of these down real quick. So an individual or a self-employed individual, that's what they would be called, is someone who actually, maybe work for themselves. Maybe they cut hair or cut grass or whatever. They're doing their own thing, but for tax purposes and business purposes, they just operate under their regular, normal Social Security number. And that's just a self-employed individual. And then so with a sole proprietor also is just a single person that has, that has, their business started too, but they may use an EIN number versus their social, but there's no legal separation between the business owner or the business when you're a sole proprietor. And it's only one member can be a sole. You can't have more than one person in a business to be a sole proprietor. Sole means one. And then an LLC, of course, offers more protection against debts and obligations and things like that. So it's a limited liability company. So the liability of the owner is limited. Say, for instance, if I own a business and things happen and I owe a lot of money for my business, if I'm a sole proprietor, then legally, whoever I owe can come after my personal things too. But if I'm an LLC, then they're limited on what they can actually affect. So my personal asset would not be tied into any obligations with the business. So that's the difference between the LLC and the sole proprietor. Also, these are some other things that show the difference. So LLC versus sole prop, because a lot of people ask the question, should I be an LLC or should I just get an EIN number? Should I use my social? Blah, blah, blah. And so by definition of different levels of sole prop and then LLC. So formation-wise, to form an LLC, you have to file articles of organization or certificate of formation with the state that you are operating in or that you're forming a business in. As a sole prop, you just get business permits and register the trade name if you're using a trade name. And then, of course, you have to get permits and trade names and things like that too with the LLC. The only difference is with an LLC, you have to register or form that business with the state that you're in. And then, of course, operations and management, the difference is an LLC, the owners can share decision-making or appoint a manager to make decisions for the LLC, while the sole prop, the owner is the only one that makes the decisions because it's just them. You can also have a single member LLC where you're the only person in the business and still have an LLC as well. So you don't have to have a lot of different people in the business to have an LLC. Tax purposes, now on the tax side, we'll talk about this later on. We'll talk about S Corp and C Corp. Pass-through taxation is the default, but LLC can elect corporate tax statuses too. And pass-through just simply means that you file an information return and then the taxes are paid on a personal level with anybody that, with any member of the LLC that had any dividends from the business or any money from the business. And then, of course, the sole prop, same thing, pass through taxation, meaning that the business taxes are paid on the individual tax return. All right, and then the legal protection, the owners aren't personally liable for business debt as an LLC, and as a sole proprietor, the owner is personally responsible for business debt. All right, and then the paperwork, I'm sorry, I'm still in people. On the paperwork side of it and the compliance side of it, of course, there's more compliance and paperwork for an LLC. You have to pay taxes, you have to renew business licenses, you have to file an annual report when you're at LLC. I'm so sorry, I'm still in people. LLCs are also advised to have operating agreements. So you have to have an operating agreement on file, and then hold meetings every now and then with your members at least once a year, and then record the membership units. And then, of course, on the sole prop, you just pay taxes and renew your business license, and that's it. That's the only compliance and paperwork you have to do with the sole prop. All right. What about corporations and nonprofits? The other business entity types are corporations, which also known as Inc. or incorporated. The corporation has limited liability, just like an LLC, and has more flexibility of transferring ownership interest or stock. So if that's the case, if corporations have limited liability too, why not be a corporation instead of an LLC? And so the only time that, I don't say only time, I can't, let me make sure I choose my words carefully, I can't advise. But the difference is if you're an LLC and you have multiple members in this particular LLC and you have particular shares, with an LLC, you're limited on transferring any ownership or any stock and things like that. It has to be filled out in the operating agreement, but also you have to go along with the state rules and regulations too. As with the corporation, you can transfer ownership, interest, and stock and things like that freely with the corporation. You can switch, owners and different things like that, add owners without it being any hiccups or any, issues. Most people choose corporations when they're going to look for outside investors to invest in partnering with them for their business, interests and things like that. But if it's just a single person, and you're going to be the only owner, might want to go the LLC way instead of being incorporated. Also, a corporation is by default have to file as a C Corp on the tax return, which we'll talk about that in just a second. And then the last business entity type is a nonprofit, which is an organization that is focused on pursuing the cause that benefits the public. But a nonprofit can make a profit. There's a misconception with the nonprofit. I don't want to start a nonprofit because I want to make money. But anyway, so a nonprofit, they can make money, but most of the funds that a nonprofit receives are going to be like donations, grants, and things like that. But they also can sell goods or services too to raise money for the cause. And so a nonprofit can make a profit. All right, cool. All right, so let's look at the tax statuses. So the business entity tax statuses. So you have C Corp and you have S Corp. Of course, by default, the taxation for corporations is a C Corp. And then the S Corp is considered a pass-through entity with single taxation of the shareholders. And then, of course, C Corp is double taxation. What does that mean? What does that mean? Taxation without representation. Anyway, okay, so I'm being goofy. So what that means is this: if you are a C Corp, if you're a C Corp and it's time to do taxes, so the business tax return be filed first on an 1120 or 1065, depending on if you have partners or not, if you're incorporated. And whatever the business income is, then you have to pay business taxes, income taxes on the business income, but then also whatever money that you receive from the business, any dividends that you received on an individual basis, you have to also file an individual tax return for that money as well. So you're taxed twice. As an S corporation, though, it's a pass-through entity, and you will file an 1120S, and that's just an information return. So that return shows you how much the business profited, but there's no business income taxes paid on the business. That money that was profited that you received as the shareholder, you filed it on the individual tax return and pay the tax return. Pay the taxes on that on the individual tax return. And I'll show you what that looks like in a minute, a real live tax return, to show you the difference. I've been pushing S Corp for a long time now. And I'll show you why when we get to the tax part of it. Just want to kind of get through some of these slides pretty fast. So, all right. So credit is king. All right, so we're going to talk about business credit and things like that. And I'm so happy that we partnered with Citizens National Bank. That is my go-to bank. That's the only bank that I use for everything. And so our guest speaker from Citizens National Bank is the VP Community Development Director, Mr. Tra Alford. Trey, are you out there? Yeah, unmute yourself because I can't hear you.
Can you hear me now, Carl?
I can hear you now. Yep. Let me pull your slide.
Okay, very good. Yeah. All right. Well, thank you, Carla, for having me. It's certainly a pleasure to take part in this discussion. And, it's one of those things where, when deciding whether or not to do this, I had to stop and think that if we've got people interested enough to take a minute and get some information about his business structures, lending, all of those things on a Saturday evening at 6 o'clock, then I want to be part of that discussion every time. So I appreciate you inviting me to sit in on this discussion, and please invite me to future discussions, because it says something, Carla, not only about you taking the time to deliver this information to the people, but it also says something about them carving out this time to receive this information. So glad to be here. I'm going to jump in here and talk a little bit about small business lending in general. I want to start that conversation, though, by talking or really just recapping some things as it relates to personal credit. So with that said, I'm going to jump to the next slide here and just, again, recap. This is, I know all of you probably have heard this before or already know this, at least in one sense or another. But when you think about credit, whether it's business credit, personal credit, whatever the case, credit is really, at its core, is the ability to receive capital now and then repay that capital later over time in installments. Another word that we use in banking for credit is trust. Obviously, in order to loan you any sum of money and have you repay it over time, we have to have a certain level of trust. And then the other thing here that credit really represents for us as bankers is an assessment of risk. And you'll hear me talk about risk and mention risk multiple times throughout this short presentation. So next, credit reports. You already know what a credit report is. Most of you have likely seen your credit report. I dare say that many of you have, requested your credit report from one platform or another, with Credit Karma probably being one of the most popular platforms these days. You can see on the screen who, really looks at your credit report, or really what's found in your credit. Who looks at your credit report? Banks, credit card companies, consumer finance companies, even cell phone companies look at your credit report these days. To the next slide here, I'll say that there are three major credit reporting agencies, as you already know. Likely the Equifax, Experian, TransUnion are the three major credit reporting bureaus in the United States. TransUnion is who we use the most, depending on what kind of loan that you walk into the bank to get. If you're getting a small business loan, it's safe to say that we're pulling a TransUnion credit report. Next slide is just to recap again, kind of show you some of the things that are and are not listed on your credit report. Those things in red are those things that are not listed on your credit report, with most people probably being surprised most by age here. It's not on your credit report. Your birth date is on your credit report, so it doesn't take much to figure out how old or young you are. The reason age is not on there is because we're prohibited as lenders to make a credit decision based solely on age. And the next slide here, credit scores. All of you know what a credit score is. Most of you probably have some general idea in terms of what your credit score is right now, especially if you're plugged into Credit Karma, which will actually show you a couple of different scores. But credit scores at the end of the day can range between 300 and 850. And for us as lenders, it's just really it's another way for us to assess risk. When you think of lenders, just really think of us as risk managers, because at the end of the day, that's what we're doing. Okay, so next slide. And again, I'm moving through these pretty fast, just as a recap of what you likely already know. I think I mentioned this earlier in terms of who's actually looking at your credit report. You may be surprised to find out that insurance companies actually look at your credit report, or even employers. And really here, what I'm trying to drive home for you is just how important credit is. Next slide. Here, I want to spend just a little bit of time on this. And the reason I'm really starting out here with your personal credit history and some of the factors that impact that is because what you're going to find as we work our way through the rest of these slides is that your personal credit history is going to play a major role in obtaining a small business loan with most lenders. So just as a recap here for some of you, some of the factors that really impact your credit score, personal credit score, is going to be payment history. That's going to be the largest factor at 35%. Paying your bills on time, that's what it all amounts to. 30% is going to be your credit utilization rate. You know, for example, if you've got a credit card with a $1,000 worth of available credit, how much of that $1,000 are you using? If you're using more than $300 of that $1,000, your credit score is taking a hit. So you don't want to overuse credit. Length of credit history is also a factor, coming in at 15%. Credit mix, that may be new to some of you. That's just simply how much installment debt versus revolving debt that you have on your credit report. And so what the credit bureaus like to see is a healthy mix between, say, auto loans and credit cards. And they want to know that you can manage both installment debt as well as revolving debt. And then new credit comes in at 10%. Most of you have seen this before, so again, I'm not going to spend a ton of time on it. Moving to the next slide. You already know really the role that credit and really the larger risk profile plays in lending. It's going to be all about the interest rate. Once you're approved anyway, it's going to be largely about the interest rate that we assign to your loan. Obviously, interest is how we make money. It's the cost of borrowing money. So the lower the risk, the lower the interest rate. The higher the perceived risk, obviously, the higher the interest rate. All right. And so going on to the next slide, here's where we kind of get into business loans, which is really what Carla wanted me to speak to. I'm going to run through 2 or 3 slides here, and then however you want to do it, Carla, whether it's now or at the end, I'll be happy to entertain any questions. But when we think about business loans, and Carla has done a really good job setting all of this up, talking about different business structures, talking about, liability that is inherent with one structure versus the other. And so really a good follow-up to that is, once you've got your small business set up, then the other thing that inevitably happens is oftentimes you need capital. So commercial lenders, when you go into the bank or credit union or whatever is your choice of or your source of capital, just know that commercial lenders are risk managers, and there's those words again. And risk managers are going to be primarily concerned with 2 factors. They're going to be concerned with, number one, your desire to repay, and number 2, they're going to be concerned with your ability to repay. And one without the other really doesn't mean much. So just sort of keeping that in mind and thinking about business loans. Business loans, I mean, you can approach the bank for a business loan for a number of different reasons, right? If you're a startup business, obviously you're approaching the bank for startup capital. If you're a startup business or even an existing business, you may approach the bank for working capital. Leasehold improvements, that's another thing that we see often. Purchasing furniture, fixtures, equipment is another reason. And in some instances, some of the larger business loans that we do involve purchasing commercial real estate. One of the questions that I got was, well, what are lenders looking for? When I walk into the bank, what exactly do you all want to see? And that's a great question. And it's one that we could talk at length about. But if you're a startup business, one of the things that we're looking for, and really the primary thing, is going to be a business plan. And in that business plan, we're going to be looking for at least 3 years of financial projections. That business plan for a startup entity is really proof positive for us that you've spent the time and energy that it takes to vet whatever idea it is that you have. You've put some things down on paper, you've done your research, your homework, and you've really vetted the idea to the extent that you feel in your heart of hearts that it's going to actually produce a profit at the end of the day. We also look at the length of time that you've been in business. A huge thing is going to be your financials, your profit and loss statements, your balance sheet, even your bank statements. Lenders also look at collateral. Collateral is huge. An unsecured loan represents the riskiest loan that we do. So obviously, we're always looking for collateral to secure the loans with. Do we look at credit? Absolutely. We look at personal, and some entities even look at business credit. And two, we look at your experience. If you're especially if you're a startup, what experience do you have? Say, for instance, if you're looking to open a restaurant, well, what experience do you have in that particular industry? And I don't have this on this slide. I thought about this after I sent it to Carla. But another thing here that I just want to mention real quick is, and it's huge, another thing that lenders are looking for is what we call skin in the game or an equity injection of some kind. So if you've got this business plan with an idea, around starting any particular business, one business or another, then what we want to know is that you believe in that business and this idea enough to actually invest some of your own capital. And a good rule of thumb is about 10%. And depending on the kind of business, the collateral, that type thing, it can be a little bit more than that. But typically a lender will look for 10%. So if it's going to take you, if your project cost is $100,000, you'll want to have either $10,000 in cash or collateral that you're bringing to the table to secure that loan. All right, next slide. I'm going to run through these real quick. Business credit scores, I was asked to speak to this. I'll say this, we as a bank do not pull your business credit scores, okay? We do our own analysis of your business credit. We do not lean on Duns and Bradstreet or Experian or any of the other entities. But just know that a business credit score is just really a quick view of the risk associated with a commercial applicant. Based on where your score falls, they range between 0 and 100. The higher the score, the lower the risk. Some of the things that you can expect to find on business credit reports are actual trade payments, public record information. So if there's been any bankruptcies by the business or anything like that, that will appear on there. Collections information will appear on there. And then even your company background and comparative data will appear on that business credit report. When it comes to calculating your business credit score, they basically take all of those things that I just mentioned, including the amounts associated with your liens, judgments, bankruptcy, demographic information, number of trade experiences, balances outstanding, all of the things that you see here on the screen are really part of the algorithm that they use to calculate your business score. Okay. Got the question, well, is it better to use my personal or my business credit? So I'd answer that question this way. While both can be important, and I say can there because, again, we don't use a business credit score. So while both can be important, the decision is ultimately up to the lender, because it's going to be the lender and their own loan policies that dictate whether they're going to use your personal or business credit score, or some combination of the two, to make a credit decision. Most lenders, I'll tell you, are going to use your personal credit score. That's why I started this presentation out talking about personal credit. But do know that not all lenders, use your business credit scores. Okay, next slide. Just real quick, some sources of business capital that you should be aware of. Obviously, banks, very fond of, because I work for one. And in all honesty, I think banks are probably better at commercial lending than anybody. I may be a little biased when I say that, but I do think that because so many banks depend largely on commercial loans to generate revenue and ultimately a profit, they're good at it because they have to be. What you'll find with a lot of credit unions is that, their bread and butter doesn't really lie around business loans or mortgage loans. They really specialize more in personal credit, but there are some credit unions that can compete and do compete with banks on business credit. One that may surprise you is credit card companies. Now, I'm going to tell you who is probably our largest competitor, and that's American Express. I'll go ahead and put that out there. American Express is pretty good at business or commercial lending. And in many markets throughout the state of Mississippi, or wherever you may be in the country, they have a profound presence there. Loan funds, I'll mention real quick: Renaissance Community Loan Fund, Lift Fund. Renaissance is on the Mississippi Gulf Coast and Gulfport. I did a seminar with them earlier today in North Mississippi. Renaissance is an excellent company. They are a loan fund, and what loan funds do is loan funds will oftentimes take on risk that banks will pass on. So some of the loans that lie outside of our risk tolerance as a bank, these loan funds will actually do. I'll give you an example. Our bank passed on a doggy daycare about 6-7 years ago, before we knew exactly what doggy daycares were. And Renaissance Community Loan Fund did that doggy daycare. And that doggy daycare, I talked to the lender at Renaissance today, is still alive and well. So that's just one example. Lift Fund is located in Memphis, Tennessee, another loan fund that, again, will take on a little bit more risk than banks or even credit unions will. And I've already mentioned American Express, Cabbage, some of the online lenders that are offering commercial loans. One thing I'll tell you is that please be careful with some of the online companies. I just talked to a contractor this week who was scammed by an online offer that he received. He was told that he could get a $400,000 line of credit. And, you know, some of the things that the company asked him to do were, to me as a banker, were kind of obviously fraudulent, but to the average consumer, the average business owner, would not be as obvious. So I would just caution you to be careful there. I think that's it, yeah.
Very good.
All
Thank
right.
you, Trace. I really appreciate it. So do you want to take questions now?
I sort of want to just stay with the flow that you prefer, Carla. If you rather just go completely through and then take questions, or if you want to take them now while they're fresh on their mind, I mean, either way.
I probably want to go ahead and go through just so we can get through with the presentation and see how much time we have left to do questions, if you don't mind.
That makes sense. Yes, absolutely.
Okay. All right, cool. Very good. I really appreciate that. Let me get the screen back up. And like Trey said, like I've learned a lot just from being with Citizens National Bank over the years with personal credit and business credit and things like that. So I do have some questions for you too, Trey, after we get done. But I'll let everybody else ask their questions too. So if you have any questions about credit or business credit, personal credit that was not answered in the presentation, please write them down and we'll be able to ask them at the end of this presentation. But I do want to go ahead and get through with the presentation so we can get our questions out. All right, so the next part of our presentation today is going to be business taxes. A lot of people think that when you're talking about taxes, we're only talking about the annual once a year when we file our taxes and IRS and things like that. Boo, nobody likes to file business taxes except me. And so we have different types of business taxes. You have use taxes, you have excise taxes, even IFTA taxes, sales taxes, payroll taxes, and income taxes. And we'll talk about those in just a sec. So let's look at some of them. So use taxes. A use tax is a sales tax, right? But it's the sales tax on a purchase made outside of your state of residence for taxable items that will be used, stored, or consumed in one's state of residence. So like say, for instance, if I buy a car in Texas, I don't pay sales taxes to Texas. But when I bring my car back to Mississippi, I have to pay a use tax to Mississippi. Even though I didn't buy that car in Mississippi, I bought it in Texas, but that's a use tax because you have to pay sales taxes one way or the other. So if you use tax is a sales tax on a purchase that you made outside of your state of residence that you brought back to your state of residence. Excise tax. An excise tax can be and are made by federal, state, and local governments and are not uniform throughout the United States. Some excise taxes are collected from the producer or the retailer and not paid directly by the customer or the consumer, and as such often remain hidden, like for example, like cigarettes or alcohol. There's an excise tax that was put on those items, but you'll never see it. But the producer or the retailer, they have to pay those excise taxes on those particular type of goods and things like that. So that's what it is as far as an excise tax. Mute whoever it is out. Okay. All right. Next, we have IFTA taxes. A lot of my truck drivers that are owner operators know all about the IFTA taxes. So IFTA taxes are just, international fuel taxes associated. It's when you're doing transportation and you're going from one state to the next, and you're purchasing fuel and things like that. You have to pay that fuel tax that's associated with that. All right, and then sales taxes. This is a big one. So I'm going to spend a little bit of time on sales taxes, not too much, but this is a big one that kind of misunderstood, right? So a sales tax is a tax paid to a governing body for the sales of certain goods and services, like your state, for example. Now you have two different types of sales taxes. You got a seller privilege tax and you have a consumer tax, okay? So the seller privilege tax, those states is where the seller is primarily liable for the tax. Now the seller must pay the tax whether or not the tax is collected from the purchaser or not. The tax is generally imposed on the privilege of doing business in the state. Since the tax is not required to be passed on to the purchaser, it is not required to be separately stated on the invoice. And so most states are going to be consumer tax states, but However, most sellers do show the tax on the invoice. Under audit, the state can only collect the tax from the seller, right? And so a consumer tax state, that's what most states are, that's what the sales tax is imposed on the buyer with responsibility for collection by the seller. So whoever's selling the items, they have to collect taxes from the person that's buying it from them, and then in turn pay it to the state on behalf of the buyer. The seller is still required, though, to remit the taxes, even if they didn't collect it from the buyer. So if they sell something for $1 and the sales tax is 7%, then no matter what, the state's going to want that 7% sales tax, whether you got it from the buyer or not. They're going to require it. But the buyer is supposed to be the one to pay it, but the seller is, responsible for collecting it and paying it. And so that's generally how the sales tax goes. Now, you're only supposed to pay sales taxes on goods that you sell to your customers. Let's talk about the sales tax for just a second. If y'all stuck me for a minute, I know some of you guys have businesses that don't have to worry about sales taxes, but a lot of you that are on here have to pay sales taxes. So I'm going to make this super clear across the board. Now, on the consumer tax side of it, say for instance, I know I have a lot of stores that do the nutrition drinks. I have a lot of you guys that we do business with. And say you buy your cups from Amazon, and you buy those cups from Amazon tax-free. You don't pay any taxes on it from Amazon, but you turn around and use that cup to sell a drink in the cup, right? And you have to charge sales taxes on the whole entire cost of that drink. And so that means that you have to tax it, right? But say, for instance, you bought a cup from Amazon and you already paid sales taxes on the cups you bought from Amazon, and you turn around and sell that cup to somebody as a drink and you charge sales taxes on the entire cup, you will get credit for the taxes that you paid to Amazon for the cup already. And so you don't have to pay sales taxes twice. It's only taxed on that item once. Try that one more time. Another thing, so say for instance, I have somebody and I do have a client that does gates and things like that. Like he, puts up gates, iron gates, and all kind of things like that, right? If this particular customer or this particular business owner, if he charges, say, $10,000 to put up this elaborate iron gate, and the gate cost $5,000 and the labor was $5,000. If he purchased the gate and he's charging, and he's going to actually, on that invoice, the customer's paying $5,000 for the gate and $5,000 for labor, then he has to charge sales taxes on the entire $10,000. But if the customer buys the gate themselves and pays sales taxes on the gate, and then the business owner charges $5,000 for the labor, then there's no sales taxes to be paid or collected by the business owner, because you're not supposed to pay sales taxes on a service. You don't pay sales taxes when you get your hair cut because it's a service. And so you only pay sales taxes on goods. If you're selling food, if you're selling drinks, prepared drinks, if you're selling any type of good, you're supposed to charge sales taxes to your customers. And even if you don't charge them sales taxes, then your state will require you to pay sales taxes on the money that you collected for the goods that you sold. And so if you're not already charging sales taxes, we need to talk about this on Monday and get you set up with a sales tax account and start getting everything together. That's one of the main things that I see businesses shut down for, and a lot of issues is mainly because of back sales taxes. People say, oh, I have to shut my business down because of back taxes. They're not talking about back income taxes. Most of the time it's back sales taxes. And so we'll talk about the whole thing later on in the presentation, but sales taxes is really important when you have a business that you have to collect and pay sales taxes for. So make sure you get that in order. All right. Next, we have payroll taxes. And I have a lot of my clients on who are doing payroll and stuff for payroll taxes. So payroll taxes are taxes that are imposed on the employers and the employees. and are usually calculated as a percentage of the salaries that employers pay their staff. Payroll taxes generally fall into two different categories: deductions from an employee's wages and taxes paid by the employer based on the employee's wages. Let me make that make sense for you in just a second. So if you have a check stub, right, and you look at the check stub and you're out, like, goodness gracious, they're killing me here. Oh, it's FICA. FICA's taking all my money. So FICA is actually a combination of Social Security taxes and Medicare taxes combined. And the way that breaks down, both the employee and employer split the cost of the FICA taxes. All right, so it's 6.2% for Social Security taxes for the employee and 6.2% for Social Security taxes for the employer. So 12.4% total taxes come out of the wages paid to that employee that goes to FICA for Social Security. And then also 1.45% goes to Medicare taxes from the employee, 1.45 goes to the Medicare taxes from the employer. And so both employee and employer are both paying 7.65% in FICA taxes. And what FICA taxes is for, it's taken directly from the employee's gross pay. Employers and employees both pay FICA taxes. You cannot opt out of paying FICA taxes. You can opt out, sometimes you can opt out of paying income taxes, but you cannot opt out of paying FICA taxes. It's a difference. So FICA taxes is not federal income taxes, and I'll show you that in just a second. And then what the funds are for is for Social Security programs and Medicare programs and different things like that is what those taxes are for. So that's why nobody, regardless of who you are, not even nonprofits, can opt out of paying FICA taxes. All right, so that's what payroll taxes are. And you also have unemployment taxes and things like that, which we'll get into that when we talk more about the S Corp. But those are the payroll taxes that businesses have to pay. Last but not least, oh, well, no, let's do an example. I said I'm going to do an example. So with the payroll taxes, we're going to look at an example in just a second. So the states have unemployment insurance. And that's funded by the payroll taxes as well. So not only do you have to pay FICA taxes as an employer, you also have to pay unemployment insurance as well, which is considered a payroll tax. And of course, that's with the Department of Labor and so forth and so on. It's like maybe 1%, depending on what state you're in. Sometimes it's 2%, just it kind of depends on where you are. But those different types of the unemployment insurance or taxes is for the government to be able to pay like unemployment benefits and things like that. It also goes towards the big fund for natural disasters, like, you know, the economic impact payments and things like that. That money comes from the unemployment benefit fund. So whenever those payroll taxes are being paid, it's being paid to cover these particular funds, whether it's FICA or unemployment. And so that's what those payroll taxes are for. But both the employee and employer has to pay for it. Why is that important? What does that mean to me, though? Because as an employer, if you're hiring somebody and you're having to pay them payroll taxes, you have to keep in mind, yeah, you're paying them to do a job, but you have to keep in mind it's still going to cost you as well. So if you're saying, okay, I'm going to pay this person $15 an hour, you have to realize you're going to pay them $15 an hour plus the extra, whatever it was, 12 point, whatever it is altogether, not 12, 6 point something, whatever it is, altogether on top of that $15 an hour. So if you're paying them $10 an hour, you're really paying them $10.65 an hour because those employer taxes have to be paid as well. And so you may want to adjust how much you're paying somebody if you're going to consider that, because you got to consider all of that in your cost to do business. And so you really want to make sure you're taking care of the bottom line for your business. And we'll show some examples of that in just a second. So a quick example of, well, no, I'll do it. I said I'm going to do an example right now, but I'll do it when we do the whole tax scenario. I'll do it all at one time just to kind of keep the flow going. All right. So that's payroll taxes. All right. So the next slide, we're going to talk about the income taxes. Now, this is my bread and butter. This is what I love to do. And I understand it really well. And I really like to help my clients understand it too. And so income taxes, all businesses except for partnerships must file an annual income tax return. Partnerships file an information return, which we'll do that in a minute. And the form you use depends on how your business is organized, talking about those different business structures. So if you are a sole prop or a self-employed individual, then you would file a 1040 tax return regardless. Even if you have a business, you would just file a Schedule C on your 1040 tax return. If you're an LLC or you're a corporation, you would normally, and you're a single member corporation or a single member LLC, you would normally file an 1120 form. And if you're a partnership, like if you're an LLC with different members in that, you have to file a 1065 form, information form. And then of course, each partner has to have their own special K1 to file on their personal taxes as well, which we'll do an example of that in just a second. S Corp, I push and push and push S Corp for a reason, because it saves you so much money when you're dealing with income taxes. Now, the way income taxes work, we all know why we have to pay sales taxes and things like that, but income taxes, I normally like to explain it so for example, say for instance, you want to sell t-shirts in the mall, right? I always use this example. You want to sell t-shirts in the mall, and in order to sell t-shirts in the mall, you have to pay booth rent, right? So the mall says, okay, if you want to come in our mall and make money in our mall, you have to pay us booth rent. And so that's the booth rent is like the taxes, right? And so the mall may say, okay, you got to pay us $1,000 a month to rent this booth. So you either pay $1,000 a month, you pay $12,000 one time up front, or you have to pay the $12,000 at the end of the year. But either way, that's the amount of booth rent that you have to pay. And so the same thing, if you want to make money with your business in the United States, you have to pay the booth rent, and that's going to be the income taxes. Whether you're working for somebody else or working for yourself, you're making money in the United States, and so you have to pay the booth rent or income taxes on the income that you make. And so, of course, they have different credits and things like that to kind of offset some things, but overall, that's the general reason why we're paying income taxes. That's kind of how I like to compare it. Now, as far as how much income taxes you make, you have to pay, depends on the tax bracket, depends on the credit that you receive, so forth and so on. And we'll kind of go into it. Let me do an actual return real quick and show you. So I have, can y'all see my screen okay? This is like a dummy return. All right, so this is Jonathan Doe. Okay, Jonathan Doe is a 43-year-old. He is in the transportation industry. He's single. He doesn't have any dependents or anything like that. And so he's going to file a tax return. Let's say John Doe is a sole proprietor first. Let's say that. All right, so if he's a sole proprietor, I'm going to show you guys the difference between S Corp and C Corp status. Okay, say he's a sole proprietor. Let's do that example first. And so if he's a sole proprietor and he's a business owner, and that's the only income that he has to report that income on a Schedule C, right? Profit and loss business tax form, right? And so let's say he's in the transportation business. All right, so forth and so on. So, and let's say for the year, John Doe made $100,000. I'll use $100,000 example. John Doe made $100,000, right? I'm gonna hit refresh. Oh, nice, John. So if you look over here, let me put my annotation out. If you look over here on this side of the screen, this is the balance due. So if it's in red, that means he owes money. And so John Doe on $100,000 owes $28,058 in federal income taxes. Uh-oh, I need somebody else. And then also owes $3,962 on state taxes from Mississippi, which is a lot of money. But of course, John Doe has a lot of write-offs. Okay, he's going to try to write everything he possibly can write off. He just bought a truck that year. He's got insurance. He's got so many different things he can write off, and we'll talk about the different write-offs in a minute. But let's just say altogether he wrote off, say, $70,000. Oh crap! I can have to take the annotation off. All right, $70,000 worth of write-offs. I'll just put it right here for now, which will leave $30,000 profit instead. And so now John Doe still owes $5,983 for federal, and then $709 to Mississippi for the state. $30,000 worth of business income. Okay. I'll show you why in a minute. But let's say John Doe made the same $100,000 and didn't pay any federal taxes at all on $100,000 either, and see what the difference will be. Okay. So let me delete this real quick. Well, let's just say 30 since that's the business profit. All right. So if he profited $30,000 with his business, he owes right at $6,000 federal, $700 for state. Let's keep that in mind. Okay. $6,000 federal, $700 for Mississippi. But if he made the same $30,000 on a W-2 and paid absolutely no federal taxes at all or state taxes at all, let's see. It's so slow. Good. I'm gonna hit refresh. Then he only owes $1,933 in federal and then $815 for Mississippi. And so it went from him owing $6,000 in federal income taxes versus $1,900 in W-2 income. So if he had W-2 income of $30,000, his tax liability is only $1,933 for income taxes. But if it was on a business, an LLC or sole prop, whatever it is, then he owes $6,000 on that same $30,000 profit. I'm going to show you why. All right, so let's go back to that scenario. Take this off. All right, so let's go back to this scenario. We'll look at the 1040 and show you the difference. $70,000. All right, so on the $30,000 profit that he made, let's look at the 1040 and see how that works. So on an individual 1040 tax return, which most people do file, the way it's set up, it has all your filing status information, so forth and so on. And then down here, it has the income, deductions, taxes, credits, and payments. So it spells out exactly how the 1040 is laid out. So from lines 1 all the way to line 15 is going to be income, okay? So his total income is going to be on line 9 is $30,000. But there's an adjustment made because he is a self-employed individual, and so they gave him a deduction of $2,119 adjustment, and so his adjusted gross income, because he's self-employed, is at $27,881 right here. Because he's filing single, no dependents or anything like that, he's filing single, his standard deduction is $12,550, and so you would deduct that from the $27,881, and then the total taxable income is $15,331. Still not bad. It is when you're trying to get a loan, though. And so then, of course, the taxes on $15,331 is $1,640. No, I'm sorry. So yeah, and so then the self-employed tax, though. So the taxes owed on $15,331 is $1,640. Where do we get almost $6,000 from then? Because he also has to pay self-employed taxes in the amount of $4,238 on the $100,000 that he made. And the reason why is because John Doe didn't pay any FICA taxes at all. And so the IRS or the government, they charge self-employed tax for self-employed individuals. What if John Doe would have did like I said and get an S corporation and do the exact same thing, make the exact same money, but pay himself this $30,000 in a payroll system, right? Before you can get to that point. Another issue with this particular tax return, doing it this way, Trey will tell you, they also look at the liability on how the ability to pay a loan back. So just because John Doe made $100,000 that year, and he wants to go to the bank and borrow $70,000 to get another truck for his business, Well, the bank's not going to look at the 100,000 that John Doe made. The bank is only going to look at his adjusted gross income, which is $27,881. And so when they factor in the $27,881 with all of the other items that he has to pay monthly anyway, it doesn't leave much room for him to pay anything back. And so when you're self-employed and you're trying to avoid paying a whole bunch of taxes, which of course you're supposed to want to avoid paying taxes, then you lose your buying power. I'm going to show you guys how to keep your buying power and still save on your taxes. And the S corporation is the way to go to do that. So let's try this all over one more time, okay? I keep on doing the same thing. All right, so let's say, John Doe, listen to what I said. And instead of John, oh crap, have mercy. I'm gonna need y'all to stay on it. Stay muted, please, if you don't mind. I don't want to boot nobody out. All right, so let's say the same $100,000 was made. John Doe has an S Corp. He elected the S Corp status as LLC. He has S Corp status. He is the only person in the business. In order to have the S Corp election, I know y'all probably can't see me, it's that dark. In order to have the S Corp status, you have to have at least one member in the business receiving wages. Wages means that you're actually paying payroll taxes in. And so John Doe made $100,000 and he paid himself. I'm gonna get you. Let me clear something. Thank you. Somebody. I know you're trying to see the screen. I'm so sorry. Let me clear your jaw now. All right. Let's see. Hold on. I know my screen is small. Let's see if I can fix this for you. It won't let me. I'm so sorry. All right. So let's say John Doe did everything I said, got the S Corp, and he's a single member LLC, S Corp status for filing taxes. He has payroll tax. He's paid the $30,000 that he actually profited from his business. He ran that through our payroll system where payroll taxes, those FICA taxes were coming out, and he was receiving a paycheck every week because he was paying himself every week. He also was having FICA taxes taken out. And so the benefit of that is this. When John Doe gets of age, because he's been paying FICA taxes on the money that he's been making, then he actually is building up Social Security for himself to be able to collect Social Security at the end of the time frame that he can collect Social Security. If he's just doing just a regular, self-employed individual, he's not paying any FICA taxes in, he's just paying self-employed tax, he's losing his Social Security benefits. And so that money has to go somewhere anyway. Why not pay it towards FICA to build up your Social Security and other benefits to doing it this way? And so John Doe paid attention to what I said. All right. So what John Doe did, since he was paying himself payroll through our payroll system, I did say our, that's a little small plug. We'll have a big plug later. So he paid himself $30,000 on the W-2 is what he would receive from his own company at the end of the year. And the taxes that he paid as an employee were $1,860 plus $435. That's $2,295 that he paid as an employee times 2 as an employer. So he paid $4,590 in payroll taxes altogether for the year on that $30,000. Okay. So that's all he paid, and he didn't pay any income taxes or any state taxes. He only paid the required FICA taxes. That's all he paid on the $100,000 that he made. And so we filed an 1120-S already for him, right? Or even if he didn't do the S Corp. Let me show you this real quick. So then, let's say he didn't do the S Corp. He had the same $100,000 on the Schedule C. I'll do this as a simple person. And he had those $70,000 worth of expenses. All right, and then also on top of those $7,000 worth of expenses, he had $30,000 worth of whatchamacallit too, where he paid himself wages and things like that. And so when I actually refresh it, he still only owes that exact same $1,933 that he would have had if he only had a $30,000 worth of W-2, instead of owing $6,000 that he would have had to pay altogether, instead of doing it that way in income taxes. And so, even though John Doe paid payroll taxes, those payroll taxes are going towards his benefits to collect again once he gets a certain age. So he's not losing that money. He's actually saving that money for his Social Security benefits. If not, the money that he has to pay in self-employed tax anyway and loses buying power, that goes away, and he has nothing to collect when he gets of age to be able to collect Social Security. But let's say John Doe did it the other way too, just like I told him. Oh crap, hold on, I didn't do that. Cancel that. I'm just going to delete this real quick. I hope this is making sense. So let's say John Doe has an S Corp. All right. And let's say John Doe paid himself, he made $100,000, he paid himself $30,000 worth of W-2 income, and he also paid in a little bit of FICA taxes too, roughly about 10%. Let's say, I meant not FICA, federal withholding of $3,000, 10%. And his business made $100,000 on the S Corp side of it, right? And so the way this looks then, because if we did it that way, the way that I just showed you, whatever, he still wouldn't have much buying power. But if we do it the other way, as far as an S Corp, he can still show a profit with his business. And also, he can also, matter of fact, let's do it this way. Let's say he paid himself $20,000 and the $2,000 worth of federal income taxes. That's how I would suggest it to him. And then the other $10,000, he made a profit with his business. And so he still keeps his buying power because his business is not losing money. His business is still making money. And when it's time to file a tax return, he will file the W-2 for $20,000 that he made. And then he also will file his K-1. Let's find my K-1. There was K1, K1. Did I pass it? I can't see. There we go. And so he profits $10,000 on his K1 from his business because that's where it passes through that entity. And so he's still going to get a refund. He still doesn't owe any taxes, even though he made $100,000 and only paid. Let's see how much did he pay? And only paid FICA taxes and some federal taxes as well. And so he's going to get a refund. There's a way that you can actually make a bunch of money. It just really depends on your accountant, as opposed to like figuring out the best way to actually make the numbers work to pay yourself a certain amount. But you know what makes everything look good or whatever, things like that. Also, it makes a difference when you have the right structure and the right entity. And so I strongly suggest for self-employed individuals or even LLCs or S Corp to think about restructuring your business if you're not filing as an S Corp, or even if you're not an S Corp. If you are filing just a regular schedule C on an individual return, at least have part of the money that you're making go through a payroll system. That way you can still keep your buying power with the bank. And then on top of that, still, get a refund at the end of the year or not have to pay so much taxes in at the end of the year. And you don't have to write a whole bunch of money off just to not pay taxes. And so there's a way to make a whole bunch of money and not pay income taxes, only pay payroll taxes, which those payroll taxes that you're paying, you'll get back once you reach a certain age. And so it's not money that's just lost. And so to me, that's the better way to do it. Another thing I'm going to show you guys real quick with the W-2. So if you look at another benefit of having a business, even if you work a regular job and you were thinking about starting your business part-time or just thinking about doing your business on the side anyway, it's a very good idea to do that. And I'll show you why. Let's say, for instance, John Doe works at the hospital or something, I don't know, and say he made $75,000 and say he paid a normal $9,600 in federal taxes because of the tax bracket he's in. It's off. All right, so this is the W-2 part that I was going to show you guys in the payroll taxes. All right, so if you look at the fact that John Doe made $75,000 on a W-2, federal taxes he paid in $9,600, Social Security taxes he paid in $4,650, and then Medicare taxes he paid in $1,088. Altogether, he paid in a little over $16,000 in taxes, FICA taxes plus income taxes, because they're taxing your income on a federal level, and then of course with the FICA benefits, and also on the state level, depending on your state. So with him paying $16,000 in taxes so far, not to include what he pays to the state, then he's only getting back $107 out of paying $16,000 on $75,000 worth of income. That's terrible, horrible, terrible, right? Because if you look at the math, 75,000 minus 16,000, that's only $59,000 left over, plus not to mention insurance and other things like that are 401k, stuff like that. And so his takeaway money that he took home is not even close to 75,000. Let's say John Doe started up his own little business on the side, or he's trying to actually get his business off the ground, and say he only made $2,500 for that year. Well, when you're starting up a business, because this was one of the questions I got, when you're starting up a business, there's no limit on the expenses that you can claim. The only thing I suggest is don't put anything in your tax return that you cannot prove. And when it comes to the IRS, as far as time is flying, when it comes to the IRS, when it comes to business expenses, they have to be ordinary and necessary to your business. I get a lot of people asking me about different TikToks they see. Well, I saw that you can actually use your EIN number for your business and your business credit and buy a car and write the whole car off. Yep and nope. Yep and nope. And the reason why is because it just depends. You can't buy a Lamborghini and you own a daycare and say, well, I'm going to buy me a Lamborghini with my business and I'm putting my business name and write the Lamborghini off. It doesn't work that way because it's not ordinary and necessary for that business. It's not like you have to have a Lamborghini to make business, make money with your daycare. But now say, for instance, you were an entertainer or a car dealer or whatever, then yep, that may help you make more money if you bought a Lamborghini because you're an entertainer and you're trying to actually get more followers or whatever. So you have to buy a Lamborghini. So yeah, you can turn around and write that off. But it just depends on if it's ordinary and necessary for your business. Most of the time you cannot write alcohol purchases off on your taxes, but if you are a winery dispensary or you have an Eskimo hut, like some of my clients over in Texas have, when you go to say New Orleans or you go somewhere else and you have to taste different drinks and things like that, and you're paying for it, that becomes a business expense because it's ordinary and necessary for that business. I hope that makes sense. And so when you're talking about, using your business credit or when to use your business credit, when not to use it, like Trey said earlier, whenever you're deciding on getting funded for your business and business capital, tax returns make a huge difference when you have a business. And so if you're writing a whole bunch of stuff off just to save on taxes, it'll be real hard to get any money from the bank because just because you say you made a lot of money, it doesn't show in your tax return because they have to pull at least the last 2 years of tax returns more than likely if you have a business, just to see if your business is either losing money or making money. You could make $100,000 on your W-2 job, but if your business is losing $50,000 every year, the $100,000 means absolutely nothing to the bank because that means that you possibly would not be able to afford to pay the loan back because you don't have $100,000 to pay the bank back because your business is taking most of your money or half of your money. And so tax returns make a big difference. And so when you have a business, structuring your business properly makes a huge difference when it comes to the taxes and having a tax professional that actually knows how to, show you different ways that you're supposed to do with your business and your business expenses. And even if you spend a whole bunch of money this year getting your business started, it doesn't necessarily mean you have to use all of those expenses on that year's tax return. Say you're just starting your business this year and you haven't really made much money at all, but you spent $50,000 towards your business. You don't have to use the whole $50,000 worth of expenses on your tax return next year. You can use the accrual method. That means absolutely nothing to y'all. Sorry about that. You can use a certain method where you can actually take partial credit for some of the expenses and then use the other expenses on the next tax return for the following year, because that's the year you're going to need them, because you're going to make more money the following year. So certain things that you have to do to make sure that everything is structured properly. Okay, I think I spent too much time on taxes, but just it's a whole bunch of different things with taxes that I would love to show y'all, but we'll do that on another workshop when it's just about taxes, but this is actually about business. As you can tell, this is my passion because I just went off into a whole rant, and this is supposed to be an example. All right, let's get back to the presentation so we can get done. All right, so employees versus contractors. This is another huge mistake that a lot of business people make. First of all, you know, when I say first of all, I'm upset. First of all, do not ever, under any circumstance, pay your employees or your workers or whoever is working for you, helping you with your business, cash. Do not do it under any circumstance. Let me take that back. Do not do it anymore. Don't do it again, because I know you probably have already. Don't do it again. You want to always have a paper trail, because documentation beats conversation all day long. And so by law, a lot of people don't know this, but by law, if you hire somebody to work for you, even if it's just for a day or for a week, if they're having to go by your rules and your regulations with the business on how they operate or do business in your business or in your facility or wherever they're working for you at, they're considered an employee, and you have to pay them as a W-2 employee, and you have to pay those payroll taxes that employers have to pay for employees. Now, if you're hiring somebody to say, come and, fix your bathroom sink at your business, or, market your business for you, and you have no say in how they do it, you're just paying them to do a job, then that would be a contractor that you would actually give a 1099 to if you had to pay them $600 or more in that calendar year. But if it's an employee, if somebody that's going under your rules, regulations, if you pay them $1, you still have to pay them as an employee. So you have to actually give them a W-2 at the end of the year and pay employer taxes for that particular employee. It is really crucial and very vital. It's not required legally, but it is very critical to have an employee handbook that spells out certain things, because sometimes, I'm not saying that this is something that we do or you should do, but if it was in your employee handbook that, you have like a 90-day grace period or something like that to have this person to come on as a contractor or whatever until they reach a certain point, then they're employees, that may actually cover, not doing it the right way initially. Certain things that you need to have in place in your employee handbook anyway, because by law, depending on what state you're in, you have to give your employees a spell out of what your policies and procedures are, so forth and so on. And if you do not do that, you can get in a lot of trouble. And the best way to do that is to have an employee handbook available. So it just covers everything that you have to do legally. And so those are things that I would suggest as far as when you have your own business and you have people that are working for you or helping you. If you're paying them, they're not helping you. You hired them. But so that's something I would suggest. All right, next slide. Business mindset. This is the last slide before we get to questions. Now, this is really important. I wish I could spend more time on it, but we're kind of running out of time. But the business mindset is huge. Now, some of the challenges that you face when you start a business. First of all, it's the positivity or the lack thereof. That's one of the biggest challenges that you have. For one, for whatever reason, we're surrounded by worker bees. People that just want to clock in on somebody else's spot, never even thought about their dream about starting their own business. And to even take the first step to even want to start a business is really important. And that's a big step. But you have to surround yourself with positive people. And sometimes the most negative people around you are your family or your so-called close friends and things like that. Oh, you're just real poopy. You ain't gonna do nothing with them. You're able to go get you another job, things like that. And so that's some of the biggest challenges. And sometimes I see a lot of couples have issues when one of the spouses, one of the husband or wife, whoever, boyfriend, girlfriend, whatever, whichever one is starting a business, I hear so many times that they're not getting support from their spouse or their significant other in the business. And so it would probably help if you explained it to, that's your own business. Anyway, so that's one of the challenges. I think that I forgot I'm being recorded. All right. And then so another challenge that you have is help. What kind of help? All help is a challenge, whether it's hiring people to help. It's hard to find good help these days, or even trying to find help from banks to get capital. If it's trying to find help from somebody to tell you how to structure your business or even help you, go in the right direction, it's hard to find help. Another big challenge is structure. Sometimes we don't even know how to structure our business to make sure it makes sense. One of the biggest challenges I see, sometimes we jump the gun. We get so excited about it. We got a couple things in place to get our business started. And then we open up our business to the public before we even finish getting everything together, which is sometimes a huge challenge. And the reason why it's such a huge challenge is once you open those doors, you're really not going to have time to pick up the things that you didn't do before you opened up. So you're kind of stuck unless you just shut down again for like maybe, a week or something to get your stuff together. But at that point, who wants to do that in business? And so sometimes we can jump the gun and that can hurt us as well. And then a big challenge for those who have switched or transitioned from working for somebody else and working for themselves is switching from that manager mindset to the business owner mindset. You can be the best manager in the world and have all kind of awards and accolades and all kind of raises from the company you work for. But then when it comes to running your own business, you have no clue the difference until you actually get in it. And everything is falling to pieces. There's no structure. There's no anything because a manager is managing systems and structures that are already in place. So that's simple. But when you're the business owner, you have to create the structure and create those processes for them to be managed. And so it's better to have those in place before you open your doors up for the very first time for a customer. And if you've already done it already, then there's a way that we can actually help you restructure it without having to shut your doors down. It just takes a little longer. But there is help though. And then of course your profit margins. With my restaurants that I have that we partner with, whenever we do our quarterly report, I see the biggest issue is improperly pricing your goods that you're serving or even your services because of the cost of goods these days are higher than normal. One of my clients has a food truck and we were looking at her profit. She's like, I'm making a lot of money, like my gross sales are there, but I don't see any profit. Like my bank account's not looking like I'm making any money. And so when we looked at everything, when we looked at everything, she was selling plates for like maybe $12. And when we broke down each item on the plate, even the cost of the plate, all the way down to the cost of the straw, it was costing her $10 altogether because wherever she was getting her French fries from, it was too much money. And so being able to properly price your items, and it's not saying that you have to overcharge because you have to be competitive in your market, but you do have to look at your bottom line. And it's not just about if you're selling food, how much the food costs. You have to also factor in how much it costs to, run the organization, employees, gas back and forth, the cost of the food, cost of the straws, cost of the cups, cost of everything, even cost of your time preparing the food and the money that it takes to prepare the food too should be factored in the cost before you actually price your food. And there's certain things that you can actually do too to make sure the margins are there and make sure your customers don't feel like they're paying too much money. Look at things that have more of a, higher margin. Like say, for instance, one of my customers that were they're in Texas, they have like a drive-through daiquiri shop. And the Jell-O shots were like 90% profit, right? But the other items that they were selling, the profit margin was a lot less, maybe 40%. And so the small change we did for that particular month was to increase sales on the Jell-O shots and to have maybe buy two, get one or whatever. And so when they they focused on selling more Jell-O shots than anything else. They doubled their profit the next month. True story. And so, you know, there's so many different challenges when you have, when you're starting a business or have a business. And so the thing that we start looking for is how to actually overcome these things. But the mindset makes a big difference. You can't be wishy-washy because your business is like your baby. Nobody's going to treat your baby like you. Nobody's going to take care of your baby like you. I don't care who, you can find the best person in the world, but nobody will treat your baby the way you treat your baby because nobody loves your baby the way you love your baby. And you can't expect somebody else to treat your baby better than you. If you do, you're going to get disappointed every time. And because this is your baby, you have to have the mindset that no matter when your baby gets sick, you can't give up, you can't stop. You have to look for ways to make your baby feel better. When your baby's doing good, you're celebrating the good things that how your baby's doing good, but you're also being precautious and looking for different things. Maybe, you know, so your baby won't bump his head over here, and so you're looking for different things to try to, you know, decrease the risk and things like that for the business actually going down. And my whole point in all that is keep the mindset of remembering why you're starting the business. And if the reason you're starting the business is to make money, you already failed. You might as well go and shut it down. So the difference between an entrepreneur and a business owner, an entrepreneur is looking for ways to actually be innovative and open up something or start something that is not in that area already. And so if there are 5 other tax offices in my area, my job, if I'm going to open a tax office, is how I can set myself apart from the other 5 and offer something else that those 5 are not able to offer. So if you're going to do a food truck, if you're going to do, you know, landscaping or whatever, sell T-shirts, how are you separating yourself from everybody else? Your website shouldn't look like every other website that is in the same industry as you in your same area. You shouldn't want to have the same kind of whatever. Like, so you have to separate yourself from everybody else. And you be the one that everybody else in that industry is trying to emulate or copy. So it's about a mindset. And so that's it on mindset. I've run out of time, so let me hurry up so we can get the questions. All right, so TBA plug alert, TBA plug alert. Of course, this is a free workshop. I'm gonna plug my business. Of course I am. All right, so real quick, we're your trusted partner in accounting and business services. These are some of the things that we offer to businesses, right? So we also do all the business formation where we set up the LLC, the operating agreement, EIN number. We search and find out if there's any extra business licenses in your area that you need. We get those done for you. We offer virtual receptionist assistance where we actually answer your phone calls for your business, because sometimes it makes a difference of the appearance of the business. I'm gonna say this real quick. I remember I was doing a training with a group of people, and I took a plate, and on the plate I had 4 quarters, a Kit Kat, a Twix, and a Snicker bar taped onto the plate. And so I held the plate up. I was like, "Who wants to bark like a dog for this plate?" Nobody said anything at all. It was 8 o'clock in the morning. Nobody's gonna bark on a plate with 4 quarters and the Snicker bar. Like, I can't eat that right now. It's too early. And so I was like, okay, somebody barked for the plate. So somebody finally volunteered and they barked. I gave them the plate. And so then I pulled out a really beautiful gift bag. It had tissue, it's like beautiful tissue paper in it. It had like a dollar bill hanging out of it. I mean, it was really nice. It was kind of big too. It was really nice. And so I was like, okay, so who wants to get on the floor and act like a snake for this bag? I had so many hands going up, and I'm like, what the crap? You want to get on the floor? All right. And so I chose somebody to do it, and they got on the floor acting like a snake. And I gave them the bag, and I asked them to open up the bag in front of everybody. And when they took the tissue paper out of the bag, the items they pulled out of the bag was a Snicker bar, a Kit Kat, a Twix, and a $1 bill. The exact same value that was on the plate that nobody wanted to just bark like a dog for. But everybody wants to get on the floor and get dirty and act like a snake, not even knowing what's in the bag. And so my whole point in that presentation was appearance is everything. Everything. No matter what type of business you have, appearance is everything. You may have that one customer to come up and go and tell everybody about your business to bring you so much business because they were so impressed, right? Now, we have to have a particular type of presence, whether it's on social media, whether it's in public, whatever, because your brand is everything. And so sometimes when you're answering your own phone, it makes a difference. And so, for example, we have ABC, I'm not going to say the business name, but ABC Landscaping, for example, answer the phones for them. And so we answer the phones as we're at ABC Landscaping. This person does not answer the phone for himself, and book their appointments for them, for him, because it's just one person. Book the appointment, schedule, appointments. We got his website going on. We got the website going and things like that. And so because ABC Landscaping is not answering his own phone, he can actually charge more than some self-employed individual that just cuts grass, but he can charge less than what the big companies do too. So he can have the in the middle price because of the appearance of his business. Also, we do employee handbooks and things like that. So when he's hiring other people to actually work for his company, they are looking at it like, well, goodness gracious, I'm not working for just, John Doe that owns ABC Landscaping. I'm actually working for ABC Landscaping that has the HR department, that has employee handbooks, that have employee onboarding, that have a whole bunch of other things. And so you're able to attract better help because of the appearance of your business. Nobody knows that ABC Landscaping is working outside of his truck. Nobody knows that. But ABC Landscaping does not answer his own phone. He doesn't deal with his own employees when it comes to hiring. And when it's time to, get money from banks and things like that, he has profit and loss statements already at his disposal because we do the payroll and bookkeeping as well. We even have a marketing and sales team that actually does try to book the appointments for ABC Landscaping and things like that. So it's a lot of different things we offer. Virtual personal assistant, HR services, payroll and bookkeeping, marketing and sales. We do logos, flyers, business cards, websites, and commercials, and a whole bunch of other things. We do have, like, for example, the virtual personal, I'll say this real quick, virtual personal assistant. That's where somebody answers your phone. You have somebody 40 hours a week answering your phone calls, booking your appointments, giving you your schedule. You may also say, hey, virtual personal assistant, I need some help with selling some of these products or help, getting some of these sales. And so they would contact our sales and marketing team to work on behalf of ABC Landscaping as their sales and marketing team. One more person working 40 hours a week. And then we may say, okay, I need HR services because I need to hire some employees. And so you have one more person working 40 hours a week as ABC Landscaping's HR service department, right? And then you also have payroll and bookkeeping, one more person doing the payroll and bookkeeping for ABC Landscaping. So ABC Landscaping may go to that one personal assistant and say, hey, I need a profit and loss statement to get this loan from Citizens National Bank. And so she would contact, or he would contact, the payroll and bookkeeping department as if that payroll and bookkeeping department for ABC Landscaping to produce that profit and loss statement. So ABC Landscaping with a virtual personal assistant has 4 employees working 40 hours a week each. And the cost of that service with TBA is only $250 a week. For 4 people working 40 hours a week only costs $250 a week. That's one of our more expensive packages though. But we do have a lot of different services and things like that. On the tax side of it though, we also we help people start their own tax business. If you want to become a licensed tax preparer, we help people do that too. We do business tax preparation, individual tax preparation, tax planning, document prep, different things like that. We do offer financing too. And so say, for instance, you want to get your business started, you want your logo, your website, your commercials, you want all of it, and say, this is a high number. Let's just say everything that you want altogether is $5,000, but you don't have $5,000 to start it. We offer financing. You can actually pay monthly on it and still get all those things up front at the same time as well. Anybody that joined our workshop with us, you also get a discount up to October 31st if you want any of those services. We're offering 25% off of any of those services. Use the discount code 2022EV as in Victor B. All right. And that being said, our website, if you have questions that we did not answer tonight that you want to ask, you can always email us at clientservices@tbastaff.com or call us. Just book an appointment with me. Business consultation, it's free. All the consultations are free. So just book an appointment and we'll get all your questions answered if you need to. That being said, are there any questions? Well, what are your questions so far from tonight? Because that's the end of it. Any questions? You guys have to unmute yourself to ask your questions, or you can actually type it in the chat if you have any questions. Questions. I do have a couple of questions for you, Trey, if you are still on. Real quick about the business credit. Are you available, Trey? Okay. All right, cool. All right, so one of the questions was on the loan funds that you talked about, like Renaissance and things like that. How are loan funds able to take bigger risks? And is there a higher interest rate when you're dealing with loan fund companies?
Well, those are both great questions. To address the first, how are loan funds able to take on more risk? Let me answer that this way. That's really their mission. You know, it's why they were created. And the way that they do that successfully at the end of the day is because they're able to secure funding from a variety of sources that, for example, we as a bank are not able to secure funding from. So because some of them are set up as nonprofits, they have pockets of support that they're able to leverage in order to mitigate their losses, and they will experience a higher degree of losses than we as a bank will, obviously, but they're able to leverage some grant monies that are out there that they're able to put into like a loan loss reserve, for instance, in order to offset those losses. The second question about interest rates. So when you think about lending and you think about loans and interest rates that we assign to loans, anytime a loan presents a larger degree of risk, it will typically have a higher interest rate assigned to it. So the short answer to your question is more than likely you will pay a little bit more in the way of interest because your particular loan or your loan request represents an elevated level of risk for that particular entity. And the reason for that is just kind of think of it this way. If I know that I'm going to experience a higher degree of losses, then I've got to have really as part of my business model, I've got to have a way to offset those losses. So I can't charge, a prime interest rate and expect to maintain my business that is taking on a larger degree of risk when you compare it to a bank or credit union or that type of thing. So short answer is yes, you'll probably pay a little bit more in the way of interest, but because those loan funds are securing their capital from grants that they write or impact investors that just simply place their money with those loan funds in order to create impact. Because they're able to source capital from a variety of sources, they don't have to charge as much in the way of interest as, say, a finance company may charge. So you're not gonna get a loan with them and pay 30% interest on it. That's not gonna happen. In fact, these loan funds will oftentimes charge interest rates that are really not drastically different than some of the rates that you'll see from banks and credit unions.
Mm-hmm. Right, very good. Yeah, because I think with Renaissance, I think it's on like maybe a 1 or 2% difference in interest depending on the type of loan that it's not that big of a difference as far as like compared to a bank. So yeah, good question.
That's exactly right.
Mm-hmm. All right, so we have a couple other questions. One question we have, let's see. When is the best time to start using payroll if you are not seeing much of a profit? It really just depends on your overall business structure. And again, of course, if you are not paying any FICA taxes at all on the money that you're making, even if you're not showing a profit, you're still not building Social Security either. And so I would say we probably need to get together and look at the reason why the business is not showing a profit. Because sometimes, I'm not saying this is your situation, but some business owners do not separate business and personal. Some businesses make $10,000 that month, and then maybe $5,000 goes towards business expenses, and then $1,000 towards their own mortgage, and $500 towards their their car note and their food and their groceries and things like that. And all of the money that the business makes, because that's their only income, goes towards all of the expenses, period. And so it looks like there's not much of a business profit. But if you say you make $10,000 that month, and only $5,000 of it goes towards the actual business, then part of that other $5,000 that does not should definitely go through a payroll system. For one, for buying power, to keep buying power. Two, to keep business and personal separate. And then also to build up Social Security and also unemployment benefits. Because say, for instance, you're an LLC and you hire yourself as an employee and you did what I told you to do, and you're paying employer taxes for unemployment, FICA, and things like that. And say the business starts going down, you have to shut down for a reason or whatever, something happens with the business, and you have to let yourself go as an employee. Then because you paid unemployment insurance for yourself as an employee, you can actually still collect unemployment benefits as an employee that the employer has already paid for. And so that's kind of, some of the benefits of doing the payroll system. But I would say your tax professional, get with me, since I'm your tax professional, and we'll kind of see the best, route, if it makes more sense to do it, or if we want to wait till the first of the year to do it, whatever. So we'll try to do that. All right. Another question we have: do you assist with business plans? We do. Business plans and projected numbers. We're literally all things to all businesses. We even kiss babies. Pre-pandemic though, we do everything. But yeah, we do business plans and projected numbers too. Let's see, next question. Do you know if only electricians, plumbers, HVAC contractors have to pay sales tax on labor, even if that is all they are charging customer buys materials? So yes, it really depends on your state though, to be honest with you, because we're talking about sales taxes. So sales taxes depend on the state. And I think Mississippi does require electricians, plumbers, and HVAC contractors to pay sales taxes on labor. But to get around that, I hope I can say this, I'm being recorded. I hope I say this right. Let me try to say this correctly. I don't want to use the word avoid. To make that fair for you as an electrician, plumber, or HVAC contractor though, if say you're an electrician, right? And the job requires wires, it requires bulbs, it requires everything. If the total job is $10,000 and your labor is only $2,000, they are going to charge you whatever is on your invoice. And so if your invoice is $2,000 just for labor, and you're only, because if I'm not mistaken, I believe if it's labor only, like if you're only doing labor and you're not even supplying any of the materials, period, then there is no sales taxes. But if you're supplying labor and materials, even if the customer is paying for the materials, then you have to charge sales taxes on the entire invoice. And so I would say get with your tax professional. I don't even know who that is. It may be one of my clients. Get with me or whoever, and we can kind of look at, invoice by invoice, the best way to possibly, make it fair for you not to have to pay so much, collect so much sales taxes. But at the end of the day, it's not you who's paying the sales taxes, supposedly anyway. You're supposed to collect that from your customer, but of course, sometimes you have to be competitive and things like that with the prices and things like that with your customers, because some people are not charging sales taxes. So it really just depends. That would be like I would say a business consultation we would need to do, look at it on an individual basis, because I have to be real careful with the things that I say being recorded. So, all right, next question concerning sales and marketing. My business currently has a website. Do you provide website review services? We do. We do website reviews. We revamp websites. We create websites from the ground up. We make suggestions We do a lot of those different services too. Very good question. All right, next question. Can I change my existing LLC name? And what is a 1099-A? So yes, you can change your existing LLC name. So the way you would do that, you would just go to the Secretary of State website and you would do like an amendment, file like an amendment for your name change. But to be honest with you, a lot of people struggle with that part of it, like, oh man, I'm going to change my business name. I want to do something different because I'm doing something different with my business, so I want to change the name. You really technically don't have to change the business name on the LLC. That could stay the same, and just however you actually promote it to your clients, you can change the name to whatever you want to. And because the only thing that the LLC name is going to be on anyway is the tax return. It doesn't matter what's on your logo or your storefront or your business cards or whatever. Or you could even do a DBA. For example, the Boston Agency LLC is my legal business name. That's what shows up on the tax return. But on my door, you see TBA Tax Group because that's part of what we do. We do taxes and things like that because initially I started out just doing taxes. But now we have a whole bunch of other stuff too. I'm glad you brought that up. That's another question I'm going to address. So I have the Boston Agency LLC doing business as TBA Tax Group, doing business as TBA Auto Group, doing business as TBA Credit Repair, so forth and so on. But I also have a TBA Properties LLC that's separate from the Boston Agency umbrella. So I have that one umbrella that a lot of businesses fall under, but because real estate is so tricky sometimes, and so many different things that can happen with real estate, I wanted to keep that LLC separate from my other businesses. For example, you can buy a property with your real estate business, and then something happens with a title or taxes, whatever, and that can actually cause that entire umbrella to have liability because that other business assets that have nothing to do with that real estate business can be liable if it's all under that one umbrella. So I kept that one separate from, my other stuff that's under the umbrella. So you can actually leave the existing LLC the same, the way it's supposed to be, the way it is right now, and just kind of do, either a DBA or, things like that. So I would say let's talk about that one too. And so then, a 1099-A. So that's like if, say, for instance, something was abandoned, like property was abandoned or things like that, a 1099-A has to be filed. Like if you're going to acquire property that was abandoned, then you would get a 1099-A form to file that as well. It's the information form is what it is for acquisition of abandoned property or abandoned property, basically. That's what the 1099-A is. All right, next question. Ooh. What are some examples of exemptions that self-employed one-person business can claim? For example, I am a realtor, and I was told that when I take clients out to eat, for my mileage driving to the office count. So I can actually send you, because you are one of my clients, I can actually just send you, I have a spreadsheet, an Excel sheet that has a whole bunch of different categories that you can write off when you're a particular type of business, and it's very general, that no matter what type of business, you can write those things off anyway. But to address the mileage back and forth to the office, that doesn't count, possibly doesn't count because it's commuting miles. You're commuting from your home to your office. But now if you left your home and you stopped by the store to get coffee and you told somebody about your business and passed out business cards, then the drive from the coffee place or whatever to your business those miles became a write-off because those are business miles now because you're actually promoting your business. But just from your home to your office, those are commuting miles because you're not doing any promotion of your business. You're not trying to make money with your business while you're out driving those miles. So no. And then of course, there's a whole bunch of stuff. Matter of fact, I'll tell you what, there's a book that you can actually get. It's called, it used to be called 422 Tax Deductions when owning the business, but now it's 1,000 and something now, I believe. What is the new one? It's a newer one now. But 422 tax deductions when on your own business. Let me see. The newer one for this year. It is, yeah, 1,001 deductions tax breaks in 2022. This is a really good book to get if you're a business owner because it has there's 1,001 things you can write off on your taxes. But again, the deductions that you write off on your taxes would need to be ordinary and necessary to your business. And so keep that in mind. And again, too, you don't want to lose buying power, so you don't want to get stuck trying to write off, any and everything. And because what it does, it makes your adjusted gross income decrease. And so if you know you're going to plan on buying a house or using your credit within the next 2 years, you want to be real careful on what you write off on your business and try to do some other things to kind of save on taxes. All right. Next question. Got time for a few more, and then we'll have to jump on. Do I need to have 3 years worth of past balance sheets before I approach financial institutions? That would be a question for you, Trey. Do you think 3 years worth of past balance sheets? No, because that would just use your tax return. You don't have to have balance sheets. I can answer that one. Not 3 years worth of past balance sheets. You would actually more than likely have to, if you are an existing business, the last 2 years of tax returns, I assume, Trey, you can correct me if I'm wrong. And then, of course, financial, like a personal financial statement for that. Is it the prior year or the same year? Like, personal financial statement on your personal things that you own and things like that. But Trey, you can answer that question better than I can. What does it take? I know it doesn't take 3 years worth of past balance sheets before approaching a financial institution, but what other items was it that you need to get a business on?
I think you did a good job. Can you hear me?
I can, yes.
Okay. I think you did a good job explaining that. Really, where the balance sheets come in, and where the balance sheet more than likely is going to be the most recent. So from your most recent audited or compiled financial statements. We use balance sheets oftentimes to get at the value of some of the collateral that you may be using to secure the loan. That's the primary reason that we get a balance sheet. But yeah, you're right. Primarily, as far as the ability to repay goes, and all the calculations around ATR is really going to be predicated on your income statement. That's key. And I really will just underscore what you're saying about write-offs. You do really want to be careful with that because at the end of the day, we're trying to calculate your ability to repay, and you're going to lose most of the things that you write off. There are some exceptions that we can actually add back. But for the most part, if you write it off, it's gone. And we're really concentrating on that bottom line number minus those deductions when we do a debt service calculation or debt to income calculation. So.
But depreciation does go back into that number, though, right?
Depreciation is not it's not a real expense, right? So if your business generates $100,000 in revenue and you own, I don't know, real property, we'll say a building, and you depreciate it in any given year, that depreciation didn't really impact that $100,000 of revenue in a real way. So yeah, we're able to actually take that depreciation and add it back to whatever that bottom line number is. I forget exactly the line number. Carly, you'll know better than that, but whatever's showing online, 30, 31, 29, whatever it is, we're able to add that depreciation back to that.
Right. Yeah. It depends on what year the tax return is. But what about business miles though? Is that added back in because you get like a certain amount, especially this year because of gas prices so high? I think they're going up to 61. I can't remember but the amount that you get per mile now is going to go up higher. And so people claiming their mileage, does that amount or that expense go back into the revenue as well?
The short answer is no, and I do know that that's another way. Mileage is sort of another way to get at depreciation, right? So Unfortunately, mileage does not count. You can't. It's not something that we add back. And let me say this: it's not something that we add back. That doesn't mean that if we're Bank A, it doesn't mean that Bank B or Renaissance or Lift Fund or some of these other entities, Cabbage, it doesn't mean that they won't add it back. Each entity, bank, credit union, whoever it is, will have their own underwriting criteria and policies and procedures that they use in order to get at a number at the end of the day that represents net income. Unfortunately, we do not add back mileage related expenses. What we do add back in.
I was
going to say we do add back interest expense. So your depreciation expense, your interest expense, we do add that back to that bottom line number. So,
okay. I didn't know that about the interest.
Yeah. So if you've got a loan and you paid, I don't know, $5,000 in interest expense, and you expense that on the, on your P&L, on your Schedule C, whatever the case, then we're going to add that back to that bottom line number as well.
Okay. Let me ask you this one more question, Trey. What about cost of goods? Does that affect does it affect it negatively on the business, the cost of goods, or is that calculated back in? How it is?
Yeah, the only loan that I can ever remember COGS being cost of goods. So only loan that I've seen that really play a role in was the PPP. With traditional lending, COGS do not really count. And without getting into the weeds on it, I mean, I have seen some small business owners hide things in COGS that we could go in and pull out. But in general, COGS will not matter. It's just obviously you can use it as a small business owner for other reasons. But from our perspective as lenders and underwriters, it does not play a role.
Okay, so if I'm a used car dealer, and my gross receipts are $100,000, and my cost of goods or what I spend on my inventory is $50,000, then I still get the $50,000 credit for my cost of goods, right?
So in that scenario, from our perspective as underwriters, we're not necessarily concerned with that top line number. I mean, that represents at the end of the day, we can calculate a gross margin just to make sure that gross number is in line with industry standards, just to sort of verify that you're running your business in a way that's consistent with other small business owners that are essentially doing the same thing you do. But as far as calculating a net number, it's not gonna play into our calculations. What we're concerned with is obviously once you've got your revenue, once you subtract out your COGS, and now we drop down to the next section of your income statement, and we start to, examine all of your other expenses. When all of that shakes out, we're gonna have a net number, and it's that net number plus any add backs of interest expense and depreciation expense, and in some cases amortization. That's going to be that number that we use to gauge your ability to repay the debt.
Gotcha. Okay. And guys, if you're business owners, the depreciation does make a big difference. So, for example, when 2017, the Tax Cuts and Jobs Act came into effect, their Section 179 helps a lot of business owners with that particular issue. So like before, if I would have bought a computer for my business, it just is an expense that goes away from my bottom line. But if I depreciate it under Section 179, then I actually get the cost back actually because it's a depreciation. So that's my mind just went right to that. Okay.
Very good
last.
point. Very good point. I just say real quick, that really gets at that point that you made about not losing your buying power earlier. So instead of writing that off in some other section of your income statement, or instead of concentrating on some of those expenses that someone asked in an earlier question, why not, if you have some asset that you can depreciate, why not go that route so that as a lender, I can add that back to your bottom line number and give you credit for it.
Same thing with COGS. Like there's certain COGS, you got me saying COGS, right? Certain costs of goods can actually go under the Section 179 too. And so instead of using it as a cost of goods, it can actually be a Section 179 depreciation to help with the bottom line, keep your buying power, and still have the write-off to help you with your taxes too. And so there's a whole bunch of different ways to structure it and properly do the taxes. For those of you who want to book an appointment with us for a free consultation, you go to our website. It is TBA, thebostoniagency.com. Click on appointment. You can actually got different categories of tax prep, tax resolution, tax planning, business services. I'm going to say business services. You can do a 30-minute consultation about payroll setup. We have all kinds of different things that we can actually do. And then, of course, choose the employer that you want to do it with me or whoever. And then just book your appointment. If you want to know more about some of the services that we provide, you click on the TBA Business Services part of our page. And it kind of has, different drop downs. It kind of shows you all the different packages that we have. We have something for truck drivers only. We have a whole department just for truck drivers and things like that, so forth and so on. So we have a lot of different things that we have on our website. On the tax side of it, what we do with my office, we do a lot of tax planning throughout the year. And so even if you plan on using us for your taxes next year, we have to start doing some things now, though. So we need to go ahead and book an appointment to do some tax planning now for next year. We don't want to wait till the year of, and it's too late to do anything that's making changes. So book an appointment with us for tax planning or business services or whatever. We are available. More than likely, we do have info and updates on our info and updates page that have a lot of different tax updates and law changes and things like that. So always go to our website if you have any questions. We also have forms available if you want IRS forms. If you need them, if you need to know where to send your stuff to, we have that available on our website. We have a whole bunch of different forms on here, whether it's IRS forms or either our forms. We have a whole bunch of different forms here. This is a really good website to use and utilize whenever it comes to, getting information about business services or taxes. I think we have one more. With welders, same thing. And I think we need to actually book an appointment to go over some structure anyway. So we'll talk about that on a one-on-one basis. I really appreciate everybody joining. I super duper hate we couldn't stream live on YouTube. We had a lot of people waiting for the YouTube to stream live to ask their questions there because they did not have a Zoom link. But I will post this on YouTube later on once this video loads. So if you want to go back and rewatch it again, it'll be on YouTube for a short period of time. It's going to be on YouTube for a long time, but I'll have it on YouTube for at least the next few days. For those who wanted the information, they can get it, and then I'll actually take it back down. All right. A lot of people pay a whole bunch of money for the information y'all got today. So y'all got it for free. All right. Thank you so much, Trey, for always being there to help with anything I need help with. I really appreciate you. Even though I know you had a busy weekend, you still took time out to be with us for 2 hours out of your Saturday evening. So I appreciate you.
You're welcome.
All right, that's it. So you guys, I really appreciate your support. If you guys have any questions, you got my number. If not, call us at the office. This is the office information real quick, just so it will be on the screen for the whatchamacallit. But that's it. We are done for tonight. You guys have a wonderful night. Thank you guys.